Most people believe credit cards are simple tools, just plastic rectangles that let you buy now and pay later, but the truth is far more unsettling. Capital One, one of America's most popular credit card issuers, built its empire not just on convenience, but on systems so subtle most users never realize how deeply they shape spending, behavior, and long-term debt. The mystery is not whether Capital One charges fees, but why so many people never see the real cost until years have passed and the damage is already done. Welcome to Meta Economy Lab, where you can learn and understand more about the economy and related topics, so you can subscribe to the channel for continuous learning. To understand Capital One's credit card secrets, we have to go back to the early days of modern credit. In the late 20th century, banks began using data models to predict human behavior. Capital One was not just another bank entering the market. It was a company built by data scientists who believed numbers could predict who would borrow, who would pay late, and who would carry balances for years. While traditional banks relied on broad categories like income and employment, Capital One pioneered hyper-targeted credit offers. They tested interest rates, fees, and rewards the same way tech companies test ads today. What worked stayed, what failed disappeared. This experimentation quietly reshaped how credit cards were sold to everyday Americans. By the early 2000s, Capital One had mastered mass personalization. Two people with similar incomes could receive completely different offers, limits, and rates. One might see a friendly cashback card, while another received a high-interest card with just enough rewards to keep them spending. This difference was invisible to consumers, but incredibly profitable for the bank. The first hidden secret lies in how interest rates are framed. Capital One often advertises ranges instead of fixed numbers. This creates hope. People focus on the lowest possible rate, not the one they actually receive. By the time the statement arrives, the decision has already been made. Another overlooked tactic is how minimum payments are calculated. Paying the minimum feels responsible, but it is mathematically designed to stretch repayment over years. Capital One, like most issuers, knows that most profits come from interest, not laissez-faire. Slow repayment is the goal. Rewards programs add another layer of illusion. Cashback feels like free money, but the rewards are often funded by higher interest rates and merchant fees. Many cardholders earn far less in rewards than they pay in interest without ever doing the math. Capital One also segments customers based on risk tolerance. Some users are encouraged to carry balances with flexible messaging, while others receive constant reminders to pay in full. The tone of communication changes based on what the data predicts you will do. A former customer once described feeling proud of a credit limit increase, only to realize later it arrived right before a period of financial stress. The higher limit made it easier to borrow during hardship, locking them into long-term interest payments. This is not accidental. Credit limit increases often follow spending patterns, not income growth. If you use your card heavily but pay just enough to avoid default, you become more profitable. Capital One systems notice this quickly. Fees are another area where secrecy thrives. While annual fees are clearly disclosed, other charges hide in timing and behavior. Interest capitalization, balance transfer fees, and penalty APRs quietly multiply costs during moments of stress. The penalty APR is especially powerful. One missed payment can trigger a rate jump that lasts months or longer. The bank frames it as accountability, but the effect is often permanent damage to repayment progress. Capital One also profits from payment timing. Payments posted after cutoff times can generate interest even if money leaves your account the same day. These small delays add up quietly. Over years, the bank's mobile app feels transparent, yet key information is buried several taps deep. People check balances, not amortization. They see rewards totals, not lifetime interest paid. During economic downturns, these systems become more aggressive. Credit is marketed as relief, even as interest rates rise. People borrow to survive, unaware they are locking into higher long-term costs. Capital One's marketing often emphasizes accessibility. No credit, no problem. This message brings millions into the system, but entry-level cards often carry higher rates that follow users as their credit grows. Data shows that many users never upgrade to better cards. They remain in the same product category for years, paying more than necessary because the system does not encourage movement once profitability is established. Another secret is how disputes are handled. Small charges are often easier to absorb than to challenge. Over time, these ignored amounts quietly increase total spending without emotional resistance. Even customer service scripts are optimized. Representatives are trained to de-escalate frustration without changing account structures. Relief comes in words, not interest reductions. Capital One also benefits from complexity. The more confusing the system, the less likely people are to optimize. Simplicity would reduce profits. This does not mean Capital One is unique or evil. It means it is efficient. It reflects a broader system where banks are rewarded for predicting behavior rather than educating consumers. The uncomfortable truth is that many users blame themselves, not the structure. Shame replaces curiosity. Questions go unasked. Understanding these secrets does not require closing your account. It requires awareness, paying in full, monitoring APR changes, and questioning automatic increases shifts power back to the user. The first takeaway is that rewards never matter more than interest. If you carry a balance, rewards are often an illusion. The second takeaway is that data works both ways. The more predictable you are, the more the system adjusts. Predictability can be used to your advantage. The third takeaway is that silence is expensive. Reading statements closely and asking questions breaks the invisible cycle. As credit systems grow more advanced, the gap between informed and uninformed users will widen. Those who understand the rules will benefit quietly, while others pay without knowing why. If this investigation changed how you see your Capital One card, like the video, share your experience in the comments, and subscribe to explore more hidden systems shaping everyday money decisions. Meta Economy Lab gives you new perspective to see and understand more about the economy and related topics, so you can subscribe to the channel for continuous learning.